Good morning, everyone. John Hutchinson with Filthy Rich Dirt Poor. Welcome to our special video edition here on Monday, January 22nd, 2024. I want to take a quick walk through some critical trends we discussed back in December and show you how those trends are continuing here in the early weeks of the new year. They are a concern, something to pay attention to, especially for those of you trading options, selling options for income. In December, we discussed the divergence between stocks valued or trading at above $100 to those trading below $100 per share. And this morning, I went back and just for checking, I wanted to go back and look at that trend and see what was happening here in January, because typically January is small cap month, and it's called the January effect. And as small caps go, the market tends to go for the full year. So there's some rationale in comparison here. And to do that, I'm going to use FinViz. This is my quick screener when I just want to get quick data for something. So I'm going to look at a little custom screen here and start with stocks that are priced between $20 and $100 per share. And I am looking at only stocks, not funds, and only those in the USA. So those are the three limitations that I'm using here. We have 1,383 stocks in that price range, so certainly a wide group. And we're going to take a look at the stats here. And what you can see is these 1,383 stocks combined are already out underperforming the stock market collectively. They're down 1.5% on the month, or technically on the year, but we'll call it month since we're still in January. If we take a little bit of a more narrow view and look at these based on index levels, we could see for the S&P 500, that's a pretty good bulk of the negative movement there, minus 1.55 for stocks on the S&P, trading between 20 and 100. For the NASDAQ, flat for the year to date. For the Dow, it's just 7 stocks. It's not a huge group to work from, slightly positive. Lower right screen here, performance year to date, just under 1%. And on the Russell, that's the problem, minus 3%. So in the latter half of 2024, you can see on this chart graph, small caps absolutely outperformed the general market, right? Significant shift in momentum in the latter half of 2023. But that momentum is not continuing here in the early part of the year for small caps. So that's more than half of all stocks, the 778 stocks just on the Russell. So again, those are small caps. And those are stocks, again, between $20 and $100. So let's take that out and now look at just stocks that are trading over $100. And again, we're going to look at all stocks. So this is 512 stocks that are trading over $100, all indexes combined. Again, stocks only, X funds, and USA only stocks. And we can see here, performance year to date is positive 2.78%. On the S&P 500, that's a little more than half of them. Performance year to date is 2.8%. On the NASDAQ, should not be a surprise. Performance is above 4.5%. As big tech has certainly led the way over the last week. On the Dow, performance is up 2%. And on the Russell, it's up 1%. So again, this cash divergence, in other words, money flows, still trending toward higher priced stocks. So for those of you with less capital who need to find lower priced stocks, this is a word of caution that you're buying more extreme volatility in those smaller cap stocks for the moment. Now, also warn everybody that at some point we're going to run into a correction. If we take a look at the SPY for a moment, you see we're in rare air up here, right? We haven't been up here in a while. Certainly a massive melt up over the last, almost 10 weeks since the beginning of November. end of October, beginning of November. The move up from early November through the latter stages of December could be or should be almost 100% attributed to Wall Street's belief that the Fed will cut interest rates multiple times this year. At this time, I do not see that happening. I still do not believe that the Fed cuts rates in March. I'm not convinced yet that the Fed will cut rates in May. The March 20 meeting is the first FOMC policy meeting of the year. They do have an interim meeting at the end of January, but I don't expect anything more than a reiteration of what the Fed said in December at that meeting. It's the March meeting where Wall Street starts to see the reality that the Fed is not likely to cut rates 4 to 6 times as the market has believed. And it's also worth noting that right now, the S&P 500 is trading at 20 times forward earnings. That is very, very bullish for what are still good, not great economic conditions. Inflation certainly coming down. And really, the move on Friday was largely predicated on a massive shift in consumer confidence. Between December and January's consumer confidence reports put out by the University of Michigan, the largest 2-month increase in consumer confidence in something like 30 years. So it's clear that consumers are feeling better about the economy. They see inflation dissipating in time. And that was the precursor for the market making that massive move higher on Friday, a 1% move, 1% plus move on Friday. So as long as we're here, we'll take a quick pre-market look at our 3 stocks for January. You can see we're still up running 11.7% as KeyCorp continues to recover post-earnings. And that was an earnings beat, by the way. Arista Networks continuing to drive higher, as is Uber, although slightly down. Pre-market open, likely down a little bit today. So overall, heading into Investors Blueprint Live on Heading into Investors Blueprint Live on February 8th, 9th, and 10th, live from Boca Raton. If you don't have your virtual ticket, still time to get one. My 10X workshop from last year, sitting on plus 91% in 11 months. Not bad, not bad. Where's my growth stocks? 37% in 11 months. Also, I guess that's average. But overall, we're doing well on our stock selection, continuing to do well on our options trading so far this year. Just keep your eye on indexes, index levels, earnings levels. Again, can't stress enough. Buy companies, trade companies with positive earnings growth. I would sidestep speculative companies in the first 1 or 2 quarters this year and continue to play a little bit of defense. At some point, we're going to see a pullback in this market. I don't know when, and I'm not trying to predict it, but at some point, this market will have a correction. It could be as early as that March 20 meeting. One last thing, just to bore the tears out of everybody with the yield curve. This is an early sign of a potential headwind on stocks over the next 4 to 6 weeks, as 10-year Treasury yields are back above 4% and trending toward that 4.5% to 5% range. A long way to go to get there. However, if the 10-year Treasury and even the 2-year Treasury start to continue to push higher, back toward 4.5% or more, that was the precursor for your decline in the S&P 500 and in stocks in general in the August, September, October period last year. So here you can see this massive move higher in the yield curve as 10-year Treasuries were valuing better than the 2-year. That precipitated the move lower in the indexes. And right now, however, yield curve still can't get back to uninversion, disinversion, whatever you want to call it. But we have we are maintaining this trend back toward the zero line in the yield curve, which would be a net positive for the economy, not necessarily an immediate net positive for stocks, but the bond traders are always the smartest guys in the room. So keeping our eye on this, but it's a short-term yellow caution signal. That's, I guess, the best way to put it. So keep your eye on that, and we'll keep our eyes on everything else. But that's wanted to review that trend with everybody, and look forward to seeing many of you at Investor Blueprint Live in just a couple of weeks. For everybody else, have a great week, and hope you have a successful week. And we'll see you again in another video very soon.